We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Wadsworth. We have a very special show today. We have Kevin Wadsworth, or North Star Charts on Twitter, and also joining us is Patrick Karim, Bad Charts. How are you guys today?
Hi, Tom.
Doing great. I was waiting for Patrick to answer there. They were both pausing. I'm doing great. Thank you, Tom. How are you?
Excellent. It's great to have you both today. We're speaking on the afternoon of Thursday, March 4th, which seems to be a very coincidental day in the markets just after the FOMC meeting, right? We're seeing a lot of stuff go down, but we have a lot of great charts to go over here today to really show this long-term conviction and what's happening in a couple different areas here. So we're going to start with a chart from Kevin. Again, North Star Charts. I noticed that you recently changed your Twitter handle to make it a little bit more accessible, right, Kev?
Yeah, I think you mentioned all the numbers after my Twitter handle last time, and I thought I'd really better get around to changing it. So yeah, North Star Charts. It's a little bit simpler for people to remember. Yeah, this is the chart for gold, and going back to around about 2004, 2005, you can see the last bull market there, and important to notice a couple of fairly large pullbacks as that bull market progressed. I think it was 2006 and 2008. We saw some sort of pretty big spikes actually in the gold price, and what's happening at the moment so far hasn't actually really matched the sort of percentage pullbacks that we saw back then. So when you put it into a historical context, what's happening at the moment is really quite normal, but it's pretty useful, I think, to have these sorts of charts to have as a guide, really, or a map to give you a clue as to where we're going. This arc is something that I developed soon after 2015, actually, when we got the third touch on the arc there. You can see the third red circle on the base of the arc, and as that process started to build out, it became fairly clear to me that there was a nice sort of arc shape pattern that was starting to build out. So as we progressed through 2017, 2018, and we saw the breakout in I think it was 2019 above the declining resistance line there, it all came together, and the arc and the breakout guided us all the way up to over $2,000. The question in my mind then was, would we get a consolidation just below the top of the cup, or the top of the arc, just below the old all-time highs? Or, as I tweeted at the time, would we push through and then pull back? Of course, we've got our answer now. And I think there's a lot of fear and a lot of concern that the price has come back as far as it has. But really, as I say, in historical terms, anything around about a 25% pullback wouldn't be out of the ordinary. And when you do the maths, that's $2,000 down to $1,500. If we went that far, would be exactly 25%. So I'm not expecting to get quite as far as $1,500, although I suppose a brief spike to that sort of level is possible, but I don't expect those sort of levels to be maintained for any length of time. But yeah, I mean, from a technical standpoint, what we're seeing at the moment is the handle building out on this cup, which is what we need to propel us much higher in months and years ahead. Bear in mind, of course, we've got the 8-year cycle low coming up in 2024. So I'm expecting some significant moves upwards ahead of that 8-year cycle low, and then pull back into that.
Mm-hmm. So, Kev, when we're looking down here at the MACD indicator, you have annotated here the two bear crosses. Does this bear cross that we just formed here, does that worry you much, or do you feel that there's a lot more support by this arc and cup formation here?
It doesn't unduly worry me. I mean, you don't really want to be seeing that. You never like to see a monthly crossover on the technical indicators on the MACD there with the wires crossing over. But the reason I've highlighted it is to show that in an ongoing bull market, it's not unusual to have a monthly cross on the MACD. It happened during the 2008 pullback there, and because we're forming there are sort of times in a bull market where these things can happen. One of them is the 8-year cycle low, and I suppose another one now is the formation of a large technical chart pattern that's setting us up for something in the future. And in this case, it's the handle on the cup or the arc formation, and that handle, in a way, the bigger and stronger it is, the more energy is being stored up and sort of kept in reserves for the next move higher. You have to sort of remember that we're seeing a lot of selling pressure here, and no doubt some shorting going on, and people becoming very bearish. And when you get very bearish sentiment, the deeper that bearish sentiment is, the more fuel that is to power the next move higher, as there are more and more people who have taken a bearish stance and to then get on board and start to believe that we're moving up again. So the more people there are on the sidelines, the better.
Mm-hmm. Pat, anything to add here on this chart?
Well, just the perfection of the arc there on the monthly is just insane. And you have the arc supporting. You have the 21-month moving average, with fine-tuned moving average, that Kevin put it. And just like that note, he put their arc broken. So unless we close a month back inside the arc, we could be in trouble. And we'll see that in another chart I put on a quarterly chart that I have, and the quarter is ending at March also. So for me, even on the quarterly chart, March is critical for gold there.
Mm-hmm. Okay, so we will move on to your chart. Is this the one that you were just talking about the quarterly close? Perfect.
So on the quarterly chart, I had fun fine tuning the moving average. Everybody sometimes 1 year, 3 year, but I played around with the moving average to try to have as many touches as I can to really give it more value. And on the quarterly chart, the 18-month moving average for the quarterly chart for gold, every time it's had a bull run, it always stayed above it, never closed a quarter below. And you could see it below in those histograms. That's the distance from the 18-month moving average. And during a bull run, you never closed below that 18-month moving average. In the 70s, those two runs, and every time you closed below, you hibernated or you corrected more severely for a certain period of time. Look at that 2000 bull run, nonstop. Sometimes it came very, very close. You see those shallow points in a mid 2005 or 6, very close. But then the gold digested whatever consolidation it had to. It went back up, and right now we're right above it. So the magic number, it's about 1726 right now. The 18-month moving average. And no matter what kind of carnage is happening today, we're early in the month. I'm kind of happy that this Fed meeting or whatever's happening, that get your selling out of the way. And I really expecting gold to, if we're in a really bona fide bull market, to close back the month above and the quarter above 1720, 1730. And all this red action is going to be encompassed into the wick of a quarterly candle. And that's noise. So that's the power of higher time frames, is all those daily minutiae, all those daily bearish signals, those weekly bearish signals. At the end of the quarter, the buyers came in and they said, no, gold can't close below 1730. That's how much it's worth right now. And technically, it'll be super bullish. We'll be back in Kevin's arc on the monthly. We'll be back above that moving average, and off we go for a good end of year for gold.
Excellent. Kevin, anything to add there?
Yeah, just to note that Jerome Powell gave his speech today, or his talk, his interview, and I don't know how many of the listeners will have listened to that, but I was listening quite carefully, and he's disappointed the markets. He's clearly not delivered what the markets wanted, and that probably won't be tolerated for very long. If the market digests everything that he said and decides that this isn't enough, and the markets start to tank, then the printing presses are going to be rolled out again, aren't they? And it's going to be hinting at even looser monetary policy, as it was in the talk today. He mentioned inflation 2 or 3 times that I counted, and I think the Fed are very much aware of building inflationary pressures, but in terms of the wider markets and general equities, if they continue to not like this, then the Fed will step in pretty damn quickly, I think, and do something about it, and that will quite possibly achieve what our friend Pat there has just been talking about, and propel gold considerably higher before the end of the month.
Excellent. All right, so we're going to move on here, Pat, to another one of your charts. You have gold and silver on this chart together. So explain to us why you put this chart together the way you did.
Well, whenever the price action is consolidating, and even emotionally, you're there. It's Pat, like, could you have gotten this wrong? But I take a step back, and then I say, okay. I always remembered, like, I do so many charts. I remember back in the early days, one of the early things that convinced me was I had noticed that when silver and gold very much, they follow the same path. Gold always opening the road, and when gold, every time it did a new all-time high, silver never failed to do it. So I don't know how much time it took. Now I put in this chart. So every time gold did a new all-time high, silver, it's in between, I think, 5 months and 40 months. After that, a monthly defined all-time high, silver always managed. So that's another reason, like, it's not a question of if, it's a question of when. Mm-hmm. And if you want a skewed, asymmetric risk reward in your favor versus the risk, well, you kind of got to use this type of like a roadmap or crystal ball, that whatever's driving gold, whatever gold is sniffing, will eventually help silver. Silver will eventually go parabolic towards the end of this mayhem run that we're going to have. And you just got to sit back, man. And we're 9 months in since gold did its all-time highs. And it's a timer at any moment. I know people say that, Patrick, you keep saying at any moment, but on the monthly chart, any moment could be 1 month, 2 months, 3 months. Like, that's not a lot of candles. But eventually, the countdown's enacted for silver to do a monthly defined all-time high. So that'll bring it above 40, 42, overshoot on the smaller time frames. So when I see that chart, it's like, sleep tight, Patrick. You're like that mountain fellow there in Jesse Livermore. He just came to check every week. He came to town to check the stock prices on the tape, and then he went away. Don't stress yourselves out, guys, unless this drastically changes. For me, that's it's almost programmed in the DNA of silver to go back and challenge its all-time highs.
Mm-hmm. Kev, anything to add here?
Yeah, I mean, gold is a barometer, isn't it? It's there. It's just constantly sits there, shining away. And the amount of gold on planet Earth hasn't changed since mankind's first set foot on the planet. So, the value of gold is always going to be sort of constant in a way. What's changing is the worthlessness of paper currencies. So, as US dollar continues to be printed into the trillions, then I'm afraid mathematics is just going to take over here. And, as Patrick says, whether it's a week from now, a month from now, or a year from now, the chickens will come home to roost on all of this, be reflected in the price of gold and of course the price of silver as well. The sort of available amount of silver on the planet is very limited, and it sure looks like we're going to need a lot of it in the coming few years if all of our technological dreams are going to be realized. So just be right and sit tight.
Mm-hmm. So as we've seen, a pretty brutal day in the markets today, Pat, I know your pinned tweet right now gives us some hope for targets for gold and silver. So why don't you share with us what those are? Well,
yeah, I have multiple type of techniques there to try to ballpark angle of exit out of an arc. Try to consider cycles where we might peak before going to a low. And for 2023, one of the recent targets there that I've had for silver, I think it's like 180. So that's like even on let's say smaller time frames, in a parabolic melt up, it could be insane the type of gains you could have in the last 10% of the move. Like most of the gains are going to happen there. So triple digits for 2023 before we melt back down into 2024. For me, it's one of the scenarios where I think I have multiple techniques that bring me close to that. And for gold, as crazy as it seems, even today, going back into the 1600s, gold's going to perform very well. I think like 6,000, same thing for a 2023 high before going down to 2024. And that gave me a nice target of gold silver ratio of about 40 or something like that. And that's also a target range for gold silver ratio at the lower band. But again, the markets, they move often slower than my imagination. So technically it's like a move that's plausible technically with the huge bases that we've created, and with Endgame Fiat debasement currency, logarithmic advances. Those are targets that are possible, but it's just a question of like fitting that into a time frame, how fast the end game is going to accelerate. And those are some of my targets there for silver and gold there.
Have anything to add there?
No, all sounds good to me. It's some of these targets do sound outlandish, as Patrick says sometimes, but you only have to look how quickly it moved from the low in March, and I think we went down to about $14, didn't we, at one point? And not very long after that, we moved up 100%, and we've not even got started yet. So yeah, excellent.
All right, we're going to move on here. Pat, I think this is one of your charts again for silver.
I did the same thing that I did with the gold chart. I put a quarterly candle chart just to zoom out, to take a breather, to make sure everything's behaving okay. And it's uncanny that I try to fine tune moving average, and the 18-month moving average behave exactly the same way as gold. So it gave me the most touches that in a bull run you would expect for the silver quarterly closes to touch without going below. And after that, it kept bouncing up and up, bringing that 18-month moving average up. And I just want to give some perspective. Right now, we're about 3 quarters in the above that moving average for silver, 275 days. And I put all the other times, the period of times that silver was able to stay above that 18-month moving average, and also only after getting stretched above that 18-month moving average. So I want to see silver say, okay, this is for real. It got velocity, it got a good momentum, it was able to distance itself from the 18-month moving average. And once that criteria was in, then I started calculating how long it could stay above. And the smallest of those bull runs, the earliest one I included, it was pre-Nixon. So some people might say, Pat, don't include that first one. But it's in between 455 days and 1,700 days that silver was able to stay above that 18-month moving average. Again, that guy from Jesse Livermore there, that mountain fellow, he also said the moves, they don't end on the first day that they start. And now this is not a day, this is a quarter, but no matter what your time frame, if the move is just a few quarters in, it's born, you can't expect it to fizzle out like right away. You got to let it time to do its thing, to reach its full momentum. And for me, silver, until I get my parabolic melt up, it's like it has to end in a parabolic melt up, right? I'm not. You got to look up for silver there instead of looking down there.
So that note that you have that says not expecting a quarterly close below 18-month moving average until bull run ends, now sitting at $21. You're basically telling us that we have support down to 21 before this breaks, right?
Exactly. But that's what people have sometimes a hard time understanding. That's a quarterly chart. So you could actually close at, you could actually dip in between the month. Let's say there's a insane market crash, US equities, they drop 80%. You could have a wick, it go all the way back down to 15, to 10, something crazy like that could happen. I would expect the markets to once that's flushed out of the system, say, guys, silver is not going to close below $21 in a bull market, and it's going to close the quarter above that $21 moving at 18-month moving average. And every month, as long as the price is above that $21 is going to be 23, 25 as time goes on. And that's just really an extreme low watermark there. So if we close a quarter below 21, I'm going to have to take a big breather and say, okay, we might be consolidating more, something changed, maybe macro, we have to hibernate a little bit. But until then, I have zero worries for silver.
Again, just removing the noise of the day-to-day, right?
Yeah, definitely.
Kev, anything to add there?
No, just love those charts. They're reducing the noise and looking at longer term trends. It's a great way to calm your nerves.
Perfect. All right, we're going to move on to I think it's the last silver chart we have. Patrick, silver's weekly log chart.
This is the commitment of trader, the open interest, and this open interest, it's the futures open interest and the options open interest. And it's like Kevin showed me a while back, like it doesn't matter the numbers of the COT. Is it a high number or low number? You have just to notice the behavior and what happened to the silver price. Just like use it like an oscillator, and try to pinpoint the behavior of the price action of an instrument versus the COT. And then it gets a lot easier to analyze the COT, and you see it gives you perspective. And every time the COT has reset to that bottom inclining trend line, so that's what's confusing. Even if the number's high, it's still inclining. Every time we touch that lower rail, that acted as support. You could do technical analysis on practically anything that's charted. And that was important places where silver actually bounced. You could see in 2003, 8, 12, and 20. And even now in 21, we retouched that inclining trend line. And we kind of had the same thing in 2009. There's a little, we touched it once, we bounced. And after that, after bouncing off those 2008 lows, we consolidated a little bit like today. And then we retested that open interest ascending bounce line. And then after that, it was off to the races to those 2011 highs. So just from that, tops in silver price were when we were hitting close to that top of the rail for open interest, and bottoms were when nobody wanted it. Everybody's closing their positions. Nobody cares for silver. Everybody's looking at the girlfriend next door, nobody cares anymore. Well, this is actually like the chart showing you what sentiment is like it's rock bottom right now. Mm-hmm. So unless the bottom falls through that and we start like closing below $21 on a quarterly chart, for me, this is like, even look at the price action, the structure, we're hogging an important breakout line, We're in between 25 and 28, really close to that up line. We're not down at 21, $18 right now. We're moving up. So for me, this is a good low risk, high reward positioning right now.
Kev, anything to add?
Just, what Patrick mentioned a moment ago there, when you're looking at technical indicators on charts or when you're looking at the commitment to traders, I approached this many years ago with a sort of a completely blank piece of paper. And I didn't even look to see what open interest meant, didn't even look to see what stochastic meant or MACD or RSI or TSI. All I was doing was looking mathematically at the relationship between the indicator, whatever it happened to be, and what price did as a result. It really doesn't matter what any of these indicators mean in a mathematical sense, because all you need to sort of take from it is, if the indicator does X, price is going to do Y. If the indicator then goes on to do, something else, then the price is going to do what? So you're just constantly looking at the relationship between the indicators and what the price is going to do. And in a sense, what the indicator is representing is pretty arbitrary. It doesn't, from a mathematical and a technical point of view, end of the day, actually doesn't really matter as long as you can work out what the relationship is between the two lines.
Mm-hmm. Perfect. All right, so we're going to move on now to, I believe it's real yields. And this is it's an interesting chart from Kevin here, because it kind of goes back to show what my recent conversation with David Brady was talking about the inverse relationship with gold price and real yields. So Kev, take it away.
Yeah, well, I stumbled on this one almost by accident, really, because I've been looking at the US dollar and its relationship to the gold price, and in a way, I suppose, being a little bit fixated by how the two sort of are related to each other. You know, dollar up, gold down, or you know, certain times when they both move in the same direction. But the yields on government debts, the interest rates, and the real yields are a huge factor in all of this as well. So the Treasury note, be it the 10-year, the 20-year, or the 30-year, issued by the U.S. government, they all pay a rate of interest that is different, of course, to the rate of inflation. Factor the two together, and you get to what the real yield is. So on the 30-year note, a fixed level of interest is paid, but you've got background inflation. And after you take background inflation into account, this is what you get. It's the real yield. So effectively, if the real yield is below zero, it means that you're paying really to borrow the money. So you're going to get back less than you've handed over. So going back to what I was saying before, where the technical indicators are not really, you know, it's not really too important what they mean in a sense. This is sort of demonstrating that as well, because the technical description of what the real yield is and what it does and doesn't represent is kind of secondary to the fact that you just sit back and notice, hang on a minute, 0.1, 0.2, 0.3, 0.4, 0.5, and 0.6 were all bottoms for gold. And I looked to this chart and I thought, hang on a minute, this chart is telling us when gold is putting a bottom in, because we've got a symmetrical triangle pattern here, and each time gold either touches the resistance line or it reaches a peak and turns down, that's gold and silver putting in a bottom. So real yields are giving us that signal. So 0.5 was interesting because we bounced off the upper resistance line on this real yield chart. And I've also marked at the bottom there just how much gold went up following each of these points. And I was having a chat with Patrick the other day, and myself and Pat, we overlaid this sort of gold prices onto this, and it just matches up, and also the US dollar. And we had the dollar index on here as well. And it turns out that when the dollar index and the real yield are both going down together, gold is supercharged and has some outsized gains. But if only one of them is going down, so if the US dollar goes down, real yields go up, or vice versa, then the gains in gold are muted. If they're both rising, then gold doesn't do well at all. So that brings us to 0.5, as I mentioned. We bounced off the resistance line and plummeted downwards, and we broke through the support line. Now, from a technical point of view, that's significant, of course, because you're breaking the support line. And what's happened since is that we've formed what is actually a bullish, expanding, descending wedge. So these chart patterns eventually are bullish for fairly obvious reasons, actually, because the support line on that expanding wedge going off the bottom of the chart just disappears off to negative infinity. You can see the slope of the line just drops away very, very sharply. So for very good reason, that is a bullish chart pattern. So from a technical point of view, you'd expect it to break out to the upside. But at 0.6, we hit the resistance line and turned down. So at 0.6, gold shot up $500 in 5 months. We now find ourselves at 0.7, where the real yield has risen. Now the Fed have something to decide here, don't they? Because the yield on the 30-year note, and then more particularly the 10-year note, in fact, when it gets to a particular level, the markets don't like it, and I think it's around about 1.5% on the 10-year note, which it briefly reached a few days ago. And I think the markets started to sort of really become very upset, and the stock markets lost quite a lot when it did that. So this brings us to yield curve control, of course, where the Fed has the ability to purchase their own debt. The government debt, effectively, is where it gets a bit ridiculous. And so money printing allows purchasing of this debt, and it sort of caps the 10-year, the rise in the 10-year note. So if you hold that down and inflation continues to rise slowly, then the real yield is going to collapse further. So that's kind of the situation we find ourselves in now. If the Fed hold back the current rise in the 10-year note and more particularly the 10-year note, and shorter yielding bonds, yielding treasury notes, then we're going to see, my expectation, looking at this chart pattern, is that gold is going to really take off, and silver as well. So we need to watch this 0.7 on this chart very, very closely, because everything on this chart going all the way back to the very start of this chart is telling us, we've got 1, 2, 3, 4, 5, 6 points there that all tell us the same thing. When the real yield turns down, gold turns up. And depending on what the dollar's doing at the time, it could turn up a lot. So yeah, it's a fascinating chart, and I've still got a lot more to get my head around on this one. It takes quite a lot of thinking to sort of put all the pieces of the jigsaw puzzle together. But it was a little bit of a eureka moment for me, and it's a chart that's going to be crucial going forwards.
Mm-hmm. And as you say, this is 6 points in only the last 10 years, right?
Absolutely, yeah. It would be really interesting to try and get the data going back further. On TradingView at the moment, it only goes back to 2010 there, I think it is. I couldn't get data going back further, but Pat's the master at getting data going back to about 1850 as far as I can tell, so he might be able to dig something out for us.
Anything else there, Pat?
I'm just fascinated. Like, for me, the gray zone, and maybe some of the viewers and the questions we get back, and when people debate, it gets heavy, is how is this going to transition? Because on some, maybe not the 30-year, but I looked at charts back in the 40s, 50s, 60s, and we were actually at like this, the rates were crushing down. And after that, like they exploded up. And I'm just wondering, like, every time I try to think that, then after that, I hear the narrative, well, the rates can't go up because of the debt. And then I go into like a circle in my head, and it just doesn't stop, Well,
this is the fundamental problem, because if you think back to the 1970s, we had rampant inflation. There are a lot of similarities between the 1960s and 70s, the situation that we kind of find ourselves in now, in a lot of ways. If inflation starts to creep up, and this never-ending sort of printing, or whatever you want to call it, of fiat currency, eventually has to be pretty highly inflationary, in my view. And we're starting to see, certainly amongst the commodity sector, we've seen inflation starting to appear. And you only have to look at the price of oil just recently to see that that's inflating as well. And all the commodity indices are inflating 20-30% in the last few months. So we're going to be trapped here, because we can't do what Paul Volcker did in the late 1970s. He can't come along and put up interest rates to 20%. That just isn't going to work. If interest rates were at 5%, the United States wouldn't have the ability to service its own debt. So how do you kill inflation if it starts to run away with itself? I don't know, and I don't particularly want to find out. But going back to this chart, from a technical standpoint, if I didn't know what this was, I'd look at it and say, this is an around the apex move building, where price crashes down out of a chart pattern, and then it forms a bullish descending expanding wedge, which indicates that the chart, that whatever it is we're charting, in this case the real yield, is going to explode upwards through the apex, in and around the apex move. But of course, if that was to happen, well, I don't quite shudder to think what's going to happen to the US economy and the rest of the world. So I haven't worked out the answer on this one yet. I have to be honest.
It's the perfect example, Tom, of chart trading versus fundamental or macro guys don't look at charts. Some people say it's impossible, rates can't go up. But let's say, like Kevin said, he didn't know anything about the US debt level, or like all these narratives that could block his pure analysis. This is telling you rates will go up. The real rates will go up. Like this is what it's telling you. Eventually, this is going to resolve upwards. So it's crazy how do you conciliate those two views? It's going to be a shock. I don't know. It's going to be it's going to be a crazy show of what's going to happen there. But the chart's telling you that eventually this might maybe a crazy drop down, but eventually it's going to go back up. This looks like the inflation chart. It looks like a lot of these charts that we had that went down and then they pop back up. So hang on there, U.S. citizens. They might increase your taxes to pay that off.
And the one last thing to mention on this, of course, as we've seen in a lot of technical charts just recently, is that false breakdowns tend to reverse violently to the upside. If you look at the chart for quite a few of the commodities, and if you look at the Bloomberg Commodity Index and a few of the others as well, we had false breakdowns and they've reversed very rapidly to the upside. And it the moves tend to be quite violent. So yeah, watch this space.
Mm-hmm. And as you say, this is very likely to resolve higher, whether it's through yields actually increasing, which is, a no-go for the Fed, as you pointed out, Kev, or whether it's inflation actually rising. So there's either way, it's a real inflection point, right?
Yeah, and it's a warning flag, really, I think. And if we break up above that resistance line there, then things are going to get very interesting very quickly.
Mm-hmm. Excellent. All right, let's move on to the US dollar, Kev.
Yeah, so this all sort of ties in. It's all pieces of a jigsaw puzzle, isn't it? Been trying to work out, the US dollar has averages 15.5-year cycle. Looking back at the dollar cycles, going back to the 1970s when Bretton Woods Agreement was taken apart, of course, and came off the gold standard. So the US dollar cycle, we're in the third of those 15-year cycles since then. And it does look as though we've just completed the 3-year cycle, which obviously is one of 5 3-year cycles that makes up a 15-year cycle. So that red sort of arc in the middle of the chart there that stretches from 2018 to 2021 is a 3-year cycle from low to low, cycle low to cycle low. And what makes me think that we've just put that low point in is that we have a bullish descending wedge that has just terminated in 2021, and we've just broken. It's a little bit hard to see on this chart, but you can just see a little. It's actually a little red candle just above the bullish descending wedge there, and of course that's probably in the process of gradually turning green at the moment as the US dollar index moves up. So that being the case, it says to me that we probably have just started the final 3-year cycle in the current 15-year cycle. So that will take us from 2021 to 2024. But the question, of course, is what path will it take us to 2024? So I've got some options there. It could be one of those 3, roughly speaking, or it could be something completely different. But my base case is the blue curve there, where we see a little bit of a bounce with the US dollar, taking us up perhaps to the mid-90s, something like that. And it being a left translated 3-year cycle. So we go up for a short period of time before descending for a much longer period of time in the 3-year cycle. So that would equate to a little bit of weakness in precious metals before we have the US dollar cycle as a tailwind rather than a headwind. But this is another one of those pieces of the jigsaw puzzle that's going to need careful monitoring and careful watching as we go through the next few months. But yeah, we'll have to pay close attention to this one, because should the US dollar suddenly start to accelerate rapidly to the upside, then we need to go back to our models and our sort of thesis and sort of factor all that into the equation. But that's how I'm seeing it at the moment, as a left translated fifth 3-year cycle.
Mm-hmm. Anything to add here, Pat?
Well, just for the US dollar, I did And I think Kevin started dabbling with it there, the 6 months chart for the US dollar, just to to reduce some noise. And it's pretty clear. I think it's like a 15 and a half year cycle for the US dollar. And that end of that bigger cycle coincides right towards, what date did it coincide, Kevin, for the 15-year cycle of the US dollar, 15 and a half year?
What, for the next low, do you mean?
Yeah, the next low.
Yeah, well, it depends whether it's nearer to 15 years or 16 years, because low to low, it does vary a little bit. So I've got the timing band somewhere between the second half of 2023 and the first half of 2024. It will be interesting, though, to see how the US election plays into that, which will be November 2024. Doesn't take too much to sort of start thinking, well, you know, if Donald Trump comes back and throws his hat in the ring, or if his son throws his hat in the ring, what that might do to the dynamics at the time. So, you know, all sorts of crazy things can happen, and probably will happen as we start to see who's in the presidential race for the 2024 election, and that could well affect things to a large extent. But that's the timing band, sort of second half of 2023 to the first half of 2024, but with a caveat that the US elections may play a part in that as well later in the year.
Perfect. Okay, so as we were talking about the commodity cycle here, we're going to move on to the copper chart from Kevin.
Yeah, thanks, Tom. Yeah, it's I've enjoyed putting this chart together. Actually, it's you know, when you sort of sit back and look at a chart and pick out the individual patterns within it, copper is an absolute beauty, really. You know, you can see so many perfect textbook chart patterns in there, and I've labelled them. Excuse me. We've got the bullish descending channel at the start there, which had an upside breakout and then led into a really nice, in fact, geometrically perfect arc basing pattern, or a cup, as some people would call it, with an upper resistance line, which was very clear to see where the breakout was in around about 2003 there, I think it was. And interesting to see that we're in a very similar position to where that black arrow is pointing to, with the little orange circle highlighted. We've got the triple exponential indicator has just crossed the zero line, and we're pulling ourselves up out of another sort of geometrically perfect arc, just as we did back in 2000, well, I suppose probably around about 2004 when we were at that point last time. And now, just like last time, I'd expect a little bit of a pause and a consolidation to take place. In fact, I'll be honest, the price of copper went a little bit beyond my projected target. I've been putting this chart out on Twitter for a year or two now, and my projected target was somewhere just fractionally below $4. I've got in a resistance zone there, and my measured move that I was projecting was to around about $3.90, something like that. And so we overshot the $4 mark, and it looks as though we're going to sort of pull back with some sort of bull flag formation. That may well take quite a period of time to build out. It could be 6 months, it could be 12 months. But of course, with the price of copper consolidating at that level, the miners will be doing very nicely, thank you, out of that. Because if you look at the chart as a whole, sustained copper prices within that red band, the horizontal resistance zone, from a historical sort of standpoint, is a very good sort of price for the miners to be getting for the raw product. And of course, by setting up a bull flag there that perhaps builds out for 6 to 12 months, that indicates very strongly, just as it did back in 2004, that we're going to see a nice, strong sort of bullish move to the upside. And of course, the fundamentals are supportive of that as well. When you think what's going on in the world around us and the movement away from, for example, things like the internal combustion engine, certainly here in the UK, they're going to be banned from 2030, which is only 9 years away. So we're not that very far away from all cars being electrified here in the UK. So I'm sure we need a lot of copper for that kind of thing. And the technological world that we're living in, and the increasing demand for all this technology, the demand for copper just isn't going to go away. So fundamental case is strong. The technical chart looks strong. Even if we came all the way back down and tested the apex on that symmetrical triangle, which from a technical point of view would be quite perfect, actually, somewhere down around about, what would it be? Somewhere just above $2.50, something like that. Perfect apex test, testing the edge of the arc, and then boom, off you go. That would be an absolute peach of a buying opportunity. So yeah, I it's a chart that I enjoy looking at this one every time I look at it, because it's just ticking so many boxes from a technical point of view.
Mm-hmm. And looking at this chart, obviously we can see in and about 2020, and as well as even back as far as, let's say, 96, this arc doesn't have to be perfectly respected, but it maybe if you sorted this by quarter, it would kind of take that wick out of there, right? It
would, yeah. This is a monthly chart, and as Pat was talking about earlier on, the wick on the candle is kind of superfluous when you're drawing a monthly chart. You're drawing your chart patterns to the monthly closes. On occasions, certainly with weekly charts, the tip of the candle can provide a sort of resting point for a support or a resistance line, but you tend to find with the monthly charts that the wicks just kind of quite often protrude out of the patterns. And even when you look at the bullish symmetrical triangle on the right hand side of the chart there, where the wick came down in 2020 or thereabouts, you can see that the line, we actually had monthly closes below the symmetrical triangle. But if you weren't aware of the arc formation at the time, you might have questioned the chart pattern and wondered what was going on. But you've got a supporting chart pattern there underneath it. So these chart patterns combine, and sometimes you can get a failure of a support line like that, but then the price action is caught. It's kind of like supported and caught by a larger chart pattern that's playing its part as well. So all of these things, they're like magnetic forces that are there to either support or to push against the price action, invisible force fields, if you like.
So, Kevin, your opinion, do you think that this, as we get closer to the end of this arc, is this going to resolve upward as it did in about 2004 there, 2005, where it had this big jump back higher?
Yeah, so having taken all of this time to build out a basing pattern that started in around about 2008 and then goes all the way through to, probably 2022 or 2023, you don't do all of that for nothing. It doesn't, it's there for a reason. These arc formations are a precursor to upward price movement. You just have to look at the Bitcoin chart, look at all of the charts, for gold and silver going back historically. And when these arc basing patterns form, that's what it is. It's a base, and it's a base for a launch higher. And that launch higher can be delayed by the occurrence of a cyclical low, for example. You can get a cycle low that occurs just near the completion of the arc that just pulls the price back for a short period of time. But it's what the arc is telling you, what the cup formation is telling you, is that we're building energy. We're building for something bigger to come in the future.
Excellent. And Pat, when we went through these charts, when we started, you were saying that this should be in a technical analyst's textbook, right?
Just like Kevin mentioned there, it's a one-stop shop there. Look, I'm looking at the tricks while Kevin was explaining, and this on a monthly chart, trends aren't overly overridden. And usually going down the downtrend, I realize like an arc, when it starts forming, it's when a downtrend hits and there's like a first violent reaction. And often a lot of people, I'm going in now, but that's just like the trend break, or like it's getting slowing down. And you could kind of see it there in the tricks going really low, starting to curve up. but it doesn't survive that unless it's a V-shaped recovery. It needs to bounce a little bit and do a higher low on the indicator and the price action. And look at today. We just did a higher low. So in 2016, 17, the tricks went down. The price action started carving out the arc. And now it decided to go up from a higher low close to that last circle. And that's a trampoline. Like, you're coiled, you're not stretched far away. The price action is really to explode, just like 2004, where you put a circle, Kevin. And it was off a higher low. For me, technically, that's it's a springboard. It's coiled. The violent first reaction is done, and now it's just primed to go up. But he's right. It could go and test that right side of the arc for a certain amount of time. And that's one of my premises right now. I think that it's silver and gold's turn to take over and continue up, but copper could go sideways up or even down a little bit. Who knows? But that's a powerful long term, and that's very supportive of higher price points. Because look at 2007, the tricks was really, really high, and then copper needed to cool down. But even with the crazy price action copper did off those March lows, the tricks is still showing you that it's not even close to topping out yet on the long term.
Perfect. All right, and for all of the uranium bulls out there, we didn't forget about you, Kevin. You sent me this chart for uranium, so let's talk about what's going on here.
Yeah, so this is it's an interesting one, isn't it? I'm quite heavily invested in the uranium sector, and I was fortunate to get in pretty close to the sector lows, actually, and gradually built my position, particularly when a lot of the miners broke out of their long-term resistance lines. So I've done very well so far, and I've been making decisions along the way whether to try and step aside when we get a significant correction. And I did actually do that with quite a lot of my positions just recently, feeling that with spot uranium failing to break out, it was increasingly likely that the miners would see a pullback of somewhere between 30 and perhaps 50%. And sure enough, here we are, a few weeks later, and spot uranium has dropped below its support level in around about the $29 sort of range. It's now falling to $27 and a few cents. And we're getting very close now to the uptrend support line, which I fully expect to hold. I don't expect price to pierce through the support line for a whole variety of reasons, partly because we've broken above the long-term resistance line. That's the solid dashed line on the left-hand side of your screen there, and we've now broken above that downtrend resistance line, and we're in an uptrending channel. And after all those years failing to get above that downtrending line, it's indicative now of a trend change. Sort of alongside that, of course, you can see the stochastic indicator on the bottom there has gone to the lowest level that it ever reaches, almost, in fact, right the way down to zero. So it hasn't got any further to fall. Of course, in a bear market, it can stay down at that level for quite a period of time, as you can see in 2016, and price continues to drop away. But I strongly believe we're not in a bear market anymore. We've turned the corner, we've broken through the resistance, and we're in the early stages of an ongoing bull market. So I would expect the stochastic indicator to turn up pretty quickly now, and for price to bounce and start to move up and through the I suppose we're actually in a small it's a declining channel, isn't it? It's sort of a bull flag that's formed since 2020, and we've seen a series. This is the fourth sort of bullish pattern that we've seen since the lows. So I fully expect price to break to the upside. And the spot uranium prices, for all sorts of fundamental reasons, you only have to look at the green policies of governments around the world, in the United States, in Canada, in continental Europe, and further afield as well in the Asian countries, and the fact that licenses on nuclear power stations are being extended. and programs for new compact, small, mini nuclear power plants are being, contracts are being awarded and plans are being approved. So, literally hundreds of these things are going to be popping up all the way around the planet. So the demand for uranium is only set to increase. And of course, mined supply is very, very limited. You can't just open a uranium mine with a click of a finger. It's a very long, drawn-out process. So with limited supply and increasing demand, even my sort of mathematics can quite quickly work out where price is going to be heading. So fundamentally, if you're holding the uranium miners at the moment, treat it as a buying opportunity. It's an absolute gift. If we get 50% discount on uranium miner prices anytime soon, as I'm speaking today, we've seen quite a few of the uranium miners pull back at least 10%. On top of yesterday's 10% pullback as well. So some good opportunities to be had in this sector, definitely.
Mm-hmm. So Kev, can you remind us what the stochastic indicator is? And it really respects that line and bounces right off of it fairly quickly, other than towards the end of 2016 there, right?
The trend momentum indicator, I mean, it's really just highlighting the direction of the prevailing trend. What's important to note is the indicator is displayed here is made up of two lines, a blue line and an orange line. And without sort of going into the technical details of it, what you have here is an indicator that shows you by the lines crossing over when to turn bullish and when to turn bearish. So in very simple terms, if you're an investor and you're looking at this indicator with a price chart directly above it, what you're looking for, apart from the fact that the indicator is declining, is for the points where the lines cross over, because a crossover of that blue line and the orange line, where the blue line rises above the orange line, as it's just starting to do now, in fact. You can zoom into that a little bit there in 2017. You can see where the blue line is above the orange line, that's bullish. So you can pick out the point just in July there of 2017 or June of 2017, where the blue line just picked up and started to move above the orange line there. And at that point, you're thinking to yourself, right, the indicator has gone down as far as it can go. We're now seeing a turn upwards. And the fact that the blue line is now above tells me, right, it's time to buy, it's time to get in. And if you look at the price directly above that, what did the price do? After that indicator crossed, of course, it went up. Mm-hmm. And the inverse is true. So when you get the opposite happening and the blue line dips below the orange line, that's your indicator to sell. And you can adjust the timeframes on these charts as well. So rather than looking at a monthly chart, you can look at a weekly chart or a daily chart, and that gives you the heads up or the indication just that little bit earlier. So you can see the indicators turning a little bit sooner when you're looking at shorter time frame charts, and the weekly chart just gives you a little bit of an earlier heads up if you think you're getting to a turning point.
Mm-hmm. Pat, anything to add here?
Well, when there's the most fear, that's how the chart looks like. So when nobody's talking about uranium anymore, you're usually, if you take a chart, you look at it and you'll see, hey, I'm at a support upwards channel. So this is like, even with the stock, I call it in the upwards channel, I call it hidden bullish resistance. So the price action refuses to do a new low, and the stock either flat or it's going maybe a little lower than the previous low. And that's just like, it's like another springboard. It's like the price action saying, look, the indicator is telling me that I suck, nobody wants me, but the price action is not confirming that. So combine that with a multi-touch upwards channel. These occasions, you don't get them often. And the earlier you catch on to them, the higher the chances of them going up, because the longer maybe a trend keeps doing up, eventually it might fail one of those tests. But especially at the beginning of a bull market in uranium and commodities, these opportunities early at the beginning, the buy right, they're happening now. But towards the end, when there's fear of missing out and everybody's talking about uranium, you're probably going to look at the chart and you're going to say, oh, look, I'm at the top of the arc. I'm close to that I need to consolidate a longer time. So for me, this is a really, like Kevin outlined, that it's a low risk, high reward proposition there that you could get in the bull market that's just starting out.
Yeah, one other thing to add, I suppose, it would be remiss of me not to mention the fact that that channel could, I suppose, by some be viewed as a bearish rising channel. It's if you look at the technical books that describe these chart patterns, when you get a sort of a rising channel like that with parallel support and resistance lines, they can sometimes indicate a bearish resolution, but that would be in an ongoing sort of bear market for the most part. So the fact that we've just broken above a long-term resistance line kind of it negates that outcome to a large extent. You wouldn't expect a bearish rising channel to form as soon as you've just broken above a multi-year downtrend line. So, and again, as I said before, the stochastic indicator is very low and ready to turn up. So that's strongly supportive of the price moving upwards, not downwards. But just to confirm that, you'd really want to see the price moving above the upper resistance line on this channel, just to sort of get price up and out of the channel and accelerating away to the upside and forming some much more sort of bullish consolidation patterns and bull flags that you'd expect to see on the way up in an ongoing bull trend. So I just thought I should mention that because some people might be looking at that saying, "Oh yes, but that's a bearish channel." There are good reasons to think that that's not the case on this occasion.
And that long-term resistance level, Kev, was at about between $28 to $29, right?
Yeah,
That's
around about 28,
band.
29. Yeah, that's right. So it's just slipped below that level. But as on the copper chart, when the price dropped down below the symmetrical triangle, the same sort of thing is happening here as well. The price dropped below that symmetrical triangle, but it was caught by the arc. And when you look at the uranium chart, price has dropped below the sort of support and resistance zone, but it's being caught by the support line on the rising channel. So, you can read the textbooks and sort of look at these things and say, "Oh no, it's broken the trade, it's broken the support line, disaster. We're gonna crash 50%." But you do have to consider, the whole picture, the big picture. And when there's another support line just below that, that's a very strong support line, going back in this case to 2017, then there's a very good reason to think that the price action is going to be supported by that support line, and we don't need to panic.
And I think one other thing to add there that you can really add to your analysis is the fundamental picture, as you were talking about the fact that we can't just turn uranium mines on the flick of a light switch, and that reserves are very depleted. Pat, anything to add there?
Well, my number one hint there for any newbie to technical analysis is zoom out. Like Kevin says, if you zoom out and you can identify those higher time frames, support and resistance levels, at least once you've identified those levels, once you zoom in and you see a smaller time frame pattern breakdown, or then you can say, but wait, I know that's let's say a quarterly chart defined support level there. So yes, I could seep through. So resistance and support is not like a strong brick wall. You could seep through, but after that, what happens? What's important is the close. So so right now,
the smaller the chart pattern, the weaker the support it gives. So if the chart pattern is only a week long and a pattern has been forming out over the course of a week, the support line on that chart pattern isn't going to be very, very strong. But if you're looking at support line that goes back 6 months, then that's going to be stronger. And if it goes back 6 years, then that's stronger again. So that try and think of it in terms of the older the line is, the harder it is to break through. And the more times it's been tested and held firm, then the stronger it is. It's like a brick wall. If someone's tried to knock it down several times and it hasn't fallen over, it's telling you that wall has been built really, really well, and you're not going to get through it. But if you build a little bit of wall out of a few Lego bricks, then okay. So the first time you try and push it over, it might stay there, but it's not going to take very much to blow it over.
Mm-hmm. Excellent, guys. Well, this was a great compilation of our a great way to come together and look at some charts from both perspectives. Can you remind some of our listeners that are maybe interested in technical analysis what some of your best resources are, where you learned this stuff? Kev, we'll start with you.
Yeah, all my stuff's online. So I started with stock charts and got an account with TradingView and tradingview.com. And that's a great place to start. If you're a novice, just get yourself a free account, start putting some charts on there, drawing a few lines, and maybe watch my Twitter feed and pick up a few hints and tips, and do as much reading around the subject as you can, just as much as you can. Online resources are never ending.
Mm-hmm. Pat, how about you?
He stole my bit. I was going to say just follow North Star charts, and that's it.
That teaches you everything you need to know.
Well, the best, you have to experiment. So follow North Star, get ideas. Try to don't look at what they do, but how their reasoning and their thought process. And after that, go in your corner and practice. Have fun. Redraw your charts. And knock them down, redraw them, and the more you practice, you're going to start seeing things. Not and you're going to start understanding. Okay, this works. Because technical analysis, I never judge somebody else the way they do it. Because if it works, you use it, and that's the beauty of technical analysis. Whatever technique you have, and the more you're resilient, and the more it works, go for it. That's the beauty of it. There's no one recipe, but. Just practice and learn and observe. Yeah,
just another tool in the toolbox, right?
Yeah.
Excellent, guys.
Everyone's got a different way of doing it, and as Patrick says, if it works, it works. And some of Patrick's charts are absolutely amazing. I never quite know what to expect from Patrick. He's got me thinking quite a lot on several occasions, and he's got a great way of sort of putting things together and looking at things from a completely different angle. And that's what we need. We need people to sort of start throwing up charts that just challenge the way we think about things.
Mm-hmm. Guys, thanks so much for your time today. This was awesome. And please, if our viewers really like this, this teamwork, let us know, and we'll get these guys back on. Guys, thanks very much for your time today.
Bye, guys.
Great. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.